On Business Incorporated today, World Bank promises to boost COVID-19 vaccine funding to $20 billion. OPEC Plus meets today to decide August oil output policy and supply pact duration. And Tunisia and Morocco sign agreement to promote employment. Hello and welcome to the program. I'm Chimeze Obi Iwago. First, the markets, and we kick off here in Africa as there was some mixed sentiments amongst the markets we track here. The NGX main index was marginally low in the red. The JSE index in South Africa was also in the red, down 0.17%. Egypt was in the green, making the EGX 30 the only gainer at intraday, up 1.32%. The Nairobi stock market closed in the green on Wednesday. And in Gulf region, it was all green at intraday. In the UAE, Abu Dhabi was up 0.93%, while Dubai rose 0.21%. Elsewhere, Saudi Arabia was up marginally 0.03%, and Qatar was up 0.71%. And in Europe, markets advanced in the morning, kicking off the second half of 2021 on a positive note as investors anticipate the continent's economic recovery. Let's talk to Ashutosh for details from the European space. Hello, Ashutosh. Good afternoon. Well, Eurozone manufacturing activity grew at its fastest pace on record in June, and we are also seeing tourism in Europe picking up. But the Delta variant is proving to be a dampener, isn't it?
Well, it is. It is definitely proving to be a dampener. You mentioned the manufacturing PMI, that's at record levels. Factory activity is at record levels, thanks to demand from the countries where these companies export to. So that's been a positive. And that record, that actually record string of records that the PMI manufacturing has been making is being actually also dampened or the sobered by what's happening as far as services is concerned. Because if you look at the southern economies like Portugal and Spain, they are actually now feeling the pinch of the rise in cases caused by Delta variant. And that's the reason why we are seeing that many businesses are actually seeing their reservations being cancelled, or the reservations have just plummeted from starting say in June, and that's because of the rise in Delta variant, and precisely because these companies had actually prepared, so they were already ready to welcome tourists, and now they are actually having to count their losses, and especially travelers from UK. There are restrictions on travelers from UK, which is itself seeing a rise in cases caused by the Delta variant. That's bad news for the Mediterranean countries. British tourists actually account for a significant minority of travelers in those countries. So in all, it's actually quite a dampener as far as the tourism sector is concerned, as far as the tourism season is concerned. And this is being reflected also in the travel and tourism stocks, which have actually taken a beating since June.
An EU's vaccine passport scheme has officially come into force from today. That should help, shouldn't it?
Well, at least that's the idea. The idea is to make travel simpler, but then airport and airline groups have warned that it could actually lead to chaos and longer queues at airports if the member countries do not coordinate its rollout efficiently. They've even called on these authorities to ensure that or come up with a system that could actually process passengers before they arrive at the airport, to actually just ensure that they spend little less time at the airports. But even if the rollout were to happen smoothly, it's not going to actually lead to a major surge in tourists. That's because not many people have got the double dose, haven't gone through the double dose vaccination, and also the fact that there are concerns around the Delta variant, so there are people who are going to be wary of traveling. So that's good. That is going to be again weigh on tourism numbers. But it's not going to be all gloom and doom. It's going to be better than 2020. It's not going to be a washout year like 2020. And clearly, passengers, the tourists are going to travel, but not in as many numbers as they traveled prior to the pandemic.
Again, financial services are set to be exempted from a new global tax system agreed to by the G7 last month. What more can you tell us?
Well, yes, that's being reported, and the reports have been citing sources that the financial services will be exempt from the new tax regime that will come in place. That is big news for the financial services, especially for Britain, which is like a hub of financial services. And this is something which the British Finance Minister Rishi Sunak was actually really pushing for. And now there are reports that maybe the OECD will agree to that demand, and that's precisely one of the reasons is that as it is, the banks have been paying higher effective tax rates, and they usually pay the taxes locally in the jurisdiction where they operate, and these are the things that the new tax regime is actually trying to focus on. And if I just could, as per Bloomberg, of the 20 biggest financial firms by assets invested in Europe and Northern America, actually 19 paid an effective tax rate of more than 15%, and with the average being 23%. So that actually, if you see, the banks have been paying a higher level of effective taxes already.
All right, thank you very much, Ashutosh. Do enjoy the rest of the day. Hope to see you tomorrow.
Thank you.
And in the UK, Chancellor Rishi Sunak took the stage at the Mansion House, outlining his new vision for UK financial services. Let's hear more from Juliana. Hello, Juliana. Good afternoon. Rishi Sunak's vision, which he outlined at the Mansion House, is shaped around 4 key themes. What are the key points of his speech?
Good afternoon, Chimese. Well, the full document will be published later, so once we have that, we'll give more details. But you're right, this morning was the Mansion House speech. It's a big, big speech. This is where the Chancellor of the Exchequer, alongside the Bank of England Governor, give out their concerns or their ideals for the economy, which of course has been rattled because of the pandemic. And there were 2 really big things that the Chancellor wanted to convey. One is the £15 billion worth of green bonds that will be available for investors. You can pay as little as £100 to invest into new ways of trying to transform the economy into net zero economy. That's the plan that British government and the Prime Minister Boris Johnson has set out by 2050. Of course, Britain is also hosting COP26 in Glasgow in November. And this is the time that the Chancellor really wants to transform the financial services, particularly post-Brexit, most notably Britain's financial services sector, the square mile, the city, really exactly where they were this morning, has been left out of pretty much all Brexit negotiations. And we know that in January, Amsterdam overtook London as being the financial hub of Europe. So there's lots of pressure on the financial services and Rishi Sunak to try and take over, to try and transform. And they want to do this by being cleaner and greener. So he announced that the bonds will be available later this year. A lot of people raised eyebrows about that. They don't know whether or not it's a gimmick or if it really is going to make the changes that he suggests. But also, I think another headline-grabbing moment from his speech is all about this new integrated sustainability disclosure requirement. Now, the previous Bank of England Governor, Mark Carney, was the first to really start putting this pressure on the financial services. So basically what a lot of these big FTSE companies would need to do, including the likes of Royal Dutch Shell and BP, is to address just how much investment is going to high carbon intensive industries. And this is what they're going to have to do by the end of the year. They're going to have to disclose it. They're going to have to make sure they're ready if there is a climate emergency, and how they are going to mitigate against the climate challenge that Britain is facing thus far. So it was a very big, important speech, usually a big dinner, actually, with hundreds of financiers. But of course, because of the pandemic, it's been scaled back, but it certainly did grab the headlines.
And BOE Andrew Bailey then turns to inflation, playing down on worries inflation will rise. This is in contradiction to Andrew Halding's warning inflation will rise. What are his prognoses?
Yeah, it's interesting, actually. Andy Holden, he was the chief economist of the Bank of England. He's left for another big job. But he was one of the only Monetary Policy Committee members to successfully keep voting against keeping interest rates at the historic low of 0.1%. He's been making comments on and off the record. And he did again say yesterday that he believes the Bank of England are being a little bit not hawkish and should raise interest rates. He believes that by Christmas, inflation could be as high as 3% here in the UK. Currently, it's at 2.1%. It swiftly surged from 0.4% in February. And now it seems as if Andrew Bailey, the Bank of England governor, used his platform this morning at Mansion House to talk down Andy Haldane. And he said that the Bank of England are looking at everything. He basically stuck with the party line. It's the same line that we've been hearing from Jerome Powell from the Federal Reserve in Washington, and that it is transitory. He said that, of course, it is because of bottlenecks, that at the moment the economy is so unpredictable that they expect, as lockdowns across the world start to be lifted, and then prices will start going back to normal. That's what he said. So it does seem as if they're sparring at the moment. But the Bank of England said they are watching very, very carefully, but they don't think it's in the best interest of the British economy to start tightening up monetary policy just yet.
All right, we'll see how that goes eventually. Let's look at some corporate news there. U.S. fashion giant Gap has confirmed it plans to close all its 81 stores in the UK and Ireland and go online only. How much of impact will this decision have on the job market in the UK? And, of course, how are the markets doing at intraday?
Yeah, this is a massive story. You've got lots of British cameras all on Oxford Street looking at the Gap store because it used to be a huge name. I think probably best known for their printed jumpers and hoodies. But they've been struggling. And again, Chimezie, we've been discussing this now for a couple of years, haven't we, about the British High Street and how it battles to remain in place because it's competing with a lot of stores that are doing pretty successfully online. I think as well as Gap, they kind of lost their way because they can't compete with the fast fashion retailers that are able to sell pretty much the same clothes, but at a cheaper price. In autumn, they decided to do a strategic review of their European stores. And just a couple of months ago, they did announce that there would be 19 store closures in Britain and Ireland by the end of the year. But alas, last night, they said they're actually going to close all of their stores, 81 stores, and that will put 1,000 jobs into jeopardy. In a statement released earlier this morning, bosses did say that they are going to be working closely with their employees to see if there is going to be some sort of transition, because I believe they will need at least a handful of people to stay on to help with their online merchandise. But yes, it is a big blow and just goes to show just how much the online fashion market has ripped to pieces the UK high street. And what's going to happen to those landlords and those places? That's a big question lots of people are asking. But at intraday, the FTSE All Share is up 0.51%. The FTSE 100 is up by 0.52%, and the FTSE 250 is up by 0.50%. In currencies, the British pound is down on the US dollar by 0.26%, down against the euro by 0.36%, and up on the Japanese yen at intraday by 0.04%. Jimmy.
All right, Juliana, thank you. We just have one more day to say thank God it's Friday. Until then, enjoy the rest of the day.
I can't wait. Thank you.
And shares in Asia-Pacific slipped today as investors reacted to the release of Chinese economic data. Mainland Chinese stocks closed lower as the Shanghai Composite declined fractionally and the Shenzhen Component slipped 0.81%. Elsewhere, the Nikkei 225 in Japan shed 0.29%. Topix Index fell 0.22%. South Korea's Kospi closed 0.44%. And markets in Hong Kong were closed on Thursday for a holiday. And the U.S. stock futures were higher in early morning trading as investors gear up for the second half of 2021. Dow futures rose 91 points. S&P 500 futures was flat, and Nasdaq 100 futures were mildly in negative territory. The latest data on weekly jobless claims will be released at 8:30 a.m. Eastern Time. Economists polled by Dow Jones are expecting initial claims for unemployment totaled 390,000 last week after totaling 411,000 for the week ended June 19. And the OPEC Plus group of oil producers are meeting today to decide on a further easing of output cut next month and could also consider extending its overall supply pact beyond April 2022. The group, comprising the Organization of the Petroleum Exporting Countries and allies, including Russia, on Wednesday, warned of significant uncertainties and the risk of an oil glut next year. The supply pact, forged in response to the COVID-19 pandemic's destruction of global oil demand, imposed record cuts of about 10 million barrels per day from May 2020, phasing out by the end of next April. Supply cuts still in place stand at about 5.8 million barrels per day. And after the break, more on commodities with a focus on coal. Do stay with us. On commodities market update, we're looking at coal. Although Nigeria is a major oil-producing country, other non-renewable sources of energy are also known to exist. These include tar sands, gas, and coal. The oldest of them all is coal. Now, Nigeria's proven coal reserves is estimated at 2.86 billion metric tons, and yet it is not a major player in the global league of producers. Why is this so? Let's talk to Aisat Dahoud, research analyst with Financial Derivatives Company. Hello, Aisat. Good afternoon.
Good afternoon. Thank you for having me.
So we've seen South Africa produce about 242 million tons, and it is the only African country in the top 10, with a current emphasis now on clean and renewable energy. What can Nigeria do to become even an average producer of coal in the world?
Okay, Nigeria has over 2 billion cubic feet of coal reserves, and the country is blessed with 22 coal fields. However, the civil war has caused many of these coal fields to, be inaccessible, and they were abandoned. So they remain underdeveloped. However, Nigerian coal is very environmental friendly. It has low sulfur, it has low ash and low moisture content. So it creates a potential coal export market for the country. Coal used to generate Nigeria lots of revenue in the 1960s till the 1970s, until the civil war happened, and just two major coal fields were able to survive the civil war, and then they were able to merge and form the Nigeria Coal Corporation that we know, which was servicing the railway system for us. Another hazard for the coal industry in Nigeria was when the railway system switched from the coal engines to diesel engines. So who had them producing for? There was nobody to produce for, and then production started to fall. Furthermore, when the mechanism system failed also, those were all these major factors added to why production, and what Nigeria can do to improve, because South Africa is only producing about 3% of the global coal production. Nigeria can also do this. If we're able to trace our steps backward to locate the coal fields, the 22 coal fields that we used to have, we develop them, build them up, and put into place the new technology mechanisms to mine and produce our rich Nigerian coal, which is environmental friendly, and then we'll start being a major player in the world of coal.
Now, in 2020, power generation from coal-fired plants fell by approximately 20%, and the global economy contracted by 3.5% because of course, the COVID-induced recession. In spite of this economic crisis, the price of coal surged by 30%, and it is anticipated to rise by about 48.3%. Well, that's according to the EIU. So can you explain why the price of this commodity is increasing at a time when the demand is falling sharply?
What actually happened was that global coal consumption dipped by 4.2% on the back of the strong decline on the global electricity usage. This was because of the effects from the pandemic. Global electricity usage dipped, and that affected global consumption. Interestingly, supply also dipped, but it dipped further than the consumption did, which allowed price to go as far as 60. Okay, initially, in 2020, after the end of the 2020, the year started, the price for coal started at $68 per ton. Then it fell to its lowest ever in that year as a result of the pandemic. It fell to $52 per ton. At the end of the year, as economic activities began to open, the gradual opening of economic activities and then, little interstate travel like that, those economic activities allowed demand to surge. It started rebounding at the end of the year, but it didn't have much impact on the whole of the 2020. So for the record for 2020, the total demand dipped despite the rebound, the heavy rebound in Q4. So that was what made the price to skyrocket like that to almost $70 per ton for coal at the end of the year of 2020, despite the huge decline. So that's what really caused it for the price.
Okay, so December 2020 marked the 5th anniversary of the signing of the Paris Agreement on climate change. The same period, China revised some of its 2030 climate targets. Now, China is the world's largest consumer of coal. What are the implications of achieving these targets on the coal industry and ultimately the price of the commodity?
So, as China is the world's largest producer, China is the world's largest consumer of coal at the same time, because many of the economic recovery strategy in China to recover from the effects of COVID is based on coal. And the impact of these on prices, gradually prices are beginning to stabilize, and we expect a slow recovery on the prices to where they used to be pre-COVID levels. However, if demand should continue to surge, because we expect demand to keep rebounding, despite it's not going to be rebound as high as we want it to in the long term, but in the short term, it's going to affect prices. Price would surge and then come to stabilize. And so in the short term, prices would remain high, while in the long term, prices would start to come down as everybody switches to renewable energies and the likes because of the cleaner environments that we all target.
Thank you very much, Aisat. We do appreciate your time. Okay, the World Bank has pledged to boost available funding for COVID-19 vaccine purchases and deployment to $20 billion from a previous target of $12 billion, citing a sharp increase in overall financing demand from developing countries. World Bank President David Malpass says the Global Development Bank had already provided more than $4 billion to 51 developing countries for the purchase and deployment of COVID-19 vaccines and would add billions for 25 more countries soon. In a joint statement, the World Bank, the International Monetary Fund, and the World Health Organization urged G20 countries to embrace vaccinated population targets of at least 40% by the end of 2021 and 60% by the first half of 2022. And Tunisia and Morocco have signed a framework cooperation agreement for the promotion of employment and competencies. The signing was done by the National Agency for Employment and Self-Employment and Morocco's National Agency for the Promotion of Employment and Competencies. The agreement provides for exchanging expertise and experiences in connection of job promotion, the development of entrepreneurship, and openness to experiences in the African continent. Both agencies outlined action strategies which are mainly focused on the digitization of services provided to job seekers, people who wish to set up their own business, and business managers. Training is another thrust to improve employability. And Rio Tinto Group has declared force majeure on customer contracts at Richard Bay Minerals after escalating violence forced it to suspend activity at the mineral sands operation in South Africa. Managing Director Wedna Vanjit said the company is prioritizing the safety of its 5,000 workers at RBM, which exports titanium dioxide slag used to create ingredients for products, including paint, plastics, sunscreens, and toothpaste. The suspension of operations at RBM is a blow to the South African government's efforts to attract new investment. Violence around RBM forced the operation to shut temporarily in 2019, with work subsequently halted on a $463 million expansion project. That's it on the program. Thank you for watching. I'm Chimize Obi Iwagu.